India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Yesterday was crunching. It was absolutely a crunching fall. Can we do a little better? I think that's the best we can hope for. Some stability is what is very much required. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant with me, my colleague Surbi and Nigel. Guys, hi, good morning.
Hi, morning. Yeah, folks. The fall now is about 7% from the peak. So at some point, the buyers will start coming in. It's just a question of when.
And I hope the margin will stop falling. I think that's the first requirement. And then we can look for some stability and some turns, etc. But, you know, for the last couple of days, even on Friday when we had the 300-point surge, on Monday morning, it didn't, and we sort of discussed this, it didn't look like this was a market which was going to turn right back on. It was looking slightly weakish because of a multitude of factors. The big context, of course, apart from everything new which is happening in terms of the consumption slowdown, etc., is the fact that everything is up. So many stocks are up 100%. They're doublers this year in 2024 after having a fantastic past 2 years as well. So that's the context here. And that's the backdrop which is very important to remember, even as you parse through what is the dominating driver. Is it a consumption slowdown? Is it X, Y, Z? The basic fact is stocks were priced to perfection and beyond in some cases. So that's essentially the fall from the all-time highs. Nifty is down about 7%. Nifty Bank is down about 6%. The mid-cap index 8%. The small-cap index down about 8% as well. So this is the fall from the all-time highs. Now, let's tell you some of the factors at play now as we start this morning. As we said, crunching fall in markets yesterday. The small cap index was down 4%. Now that's we don't see a 4% fall on the broader markets, but we did see yesterday 10:1 was how much declines outnumbered advances. So it was kind of a one-way street really, and you really had to struggle to find big volume-led gainers yesterday. There were about 3 or 4, and we'll talk more about that as we go along. Yields continue to remain strong. Now, the 10-year was up just 1 basis point, but basically it's holding on to the 4.2 odd level. Dollar index has moved past the 104 levels as well. This is a point that people are making as we get closer to the elections in the US and as the market gets more certainty that Donald Trump is ahead. It's US exceptionalism in that sense, which will push these things up. Now, oil prices, 2% pop, 75.65. So you've essentially got yields, dollar and oil, all which are slightly higher, and equities which are absolutely flat. Actually, nothing very much in terms of US equities at all. Gold prices, they are, by the way, flirting with 2750 kind of levels. They were up another 1%. So gold prices, if there is a rate cut cycle which is going to ensue, gold perhaps goes even higher. We'll see. So we sort of tie this up with levels here on the as far as the market is concerned. Many indicators, like the case was on Friday morning and Thursday morning, many indicators on the Nifty at least are approaching what you would describe as oversold levels. But the fact is, the Nifty price action doesn't suggest that there is a reversal which is around a big reversal which is around the corner, or a durable reversal which is around the corner. And the basic reason is that we are still below daily and hourly moving averages. You essentially need to get past and get above some of these levels for us to hope for any kind of move up. Immediately on the downside, the level to watch is 24,214. We left off at 24,472, so not very far away, 200 points away. That's a daily lower Bollinger Band. We'll see if the market if the Nifty works its way through down to those levels in terms of what levels under that are going to be. On the way up, of course, it's the 40 hourly exponential moving average, which now stands at 24,800, which is again not very far away, about 1.5%. But we need to do that for some semblance of stability to start to come back. The Bank Nifty at the day's high, like on Monday, it tested the 20-day moving average and then saw selling pressure. On the downside, the near-term levels are 51,000, and then you get to the recent sort of lowest point, which is 50,194. Again, both are pretty close by to where we left off yesterday, which is 51,257. And in the way up here, the markers which the bank nifty needs to climb above the 40-day exponential, which is 51,827, and the 20-day moving average, which is 52,141. I mean, at the margin, this silver lining perhaps is the fact that there are a few earnings, at least as we sort of start this session, which are also good. I mean, it's not all bad. We'll talk more about those earnings as we go along. But otherwise, it's a pretty flattish picture, maybe a little adversarial on a day-on-day basis for global markets. But the market here, of course, navigating some tough times. Surabhi.
Absolutely, Prashant. And what's kind of rubbing salt on wounds is I was looking at the Japanese market. The headline there is the subway operator, right? Tokyo Metro.
Yeah.
It's a huge sort of listing as well, about $2 billion. And that one's popped 45%. We here in India had the big Hyundai listing and it tanked along with the rest of the market. So it's just,
I think that's the biggest IPO they've seen in the last 6 years.
Absolutely, yeah. So, I mean, no comparing apple to oranges, but in terms of when, look at headlines coming through, Hyundai lists in India, shares tank 7% on debut, and there's, a large listing out of Japan, which is flying away 45% higher. But anyway, I mean,
misery loves company. Huh?
Sorry?
Misery loves company. We don't have company.
We don't have company. That's the problem, yeah. So, I mean, to cut the long story short, basically, some of the markets around Asia are doing quite okay. Hong Kong, is up and about. China is up and about. Japan's not doing too bad. Let's talk about what's going on over here. Yesterday, all kinds of levels were broken. So 100 DMA gone, last week's low gone. The question is, where does this really end? And it's the combination of these twin factors, no let up in FPI selling and the fact that earnings have been really all over the place. It's not turning out to be a good season, at least so far. Now, on the FPI selling bit, yesterday's number was again around 4,000 crores. Domestic institutions were offsetting that as usual. That's the trend that we've seen. 5,800 crores of buying coming in from domestic institutions, but it's clearly not enough as there's a lot of stock churn going on. Let's quickly come to the numbers because that's where the additional painful headlines or the additional painful information is really coming in from. If you look at post-market results, now, this whole asset quality issue is really showing up for not just banks, but NBFCs as well. Look at, Bajaj Finance, the margin picture, the AUM growth picture is fine. But even a company like Bajaj Finance is talking about slightly higher credit costs. And, the question is what happens from here, if it's peaked out or not. That's what the management has been sort of guiding for. M&M Finance, I mean, look at what we've seen yesterday. Sharp rise in provisions. The credit cost on a year-on-year basis has moved from 2.5%, from 1.5% to 2.5%. Guidance has been cut by the NBFC as well. ICICI Pru has missed the mark on several parameters. Shoppers Stop, EBITDA has fallen. At a net level, the loss has widened to 20 crores. So none of this is sort of being very comforting, but let's not get too negative. There are the bright sparks here and there as well. Amber would be one of them. Persistent has come out with very good numbers, good growth. And let's not forget Zomato. The whole profitable journey, the whole story continues, the scale-up continues, and those numbers, the internals on the quick commerce business are looking really, really solid for Zomato. So it's a mixed bag, but yes, it is more negative than positive. That is something we can't hide away from. Just leaving you with today's major numbers. Lever, very, very important to see what Lever says with the whole focus on, rural and FMCG. Bajaj Finserv, Pidilite, there'll be SBI Life, United Spirits and TVS Motors. So plenty of numbers. Hopefully some of them will light up some cheer.
Well, that's right. And overnight, the cues that stacked up against us are the three top indicators that we look at. The dollar index was stronger. The yields moved up a little bit. And also, you did see that, overnight Brent crude prices didn't cool off. We're back at around $76 per barrel. So all these three monitorables not in favor of the bulls as of now. Why are the Indian markets seeing selling? Well, we have more number of earnings misses than hits. And at least the US market, you're getting a couple of pops. General Motors was up overnight. You had Philip Morris as well that was up. Both of them were up close to around 10%. So I think the bulls would like to see one of those big earnings beats. That's what will change mood a little bit. So that's, the earnings misses have outweighed the beats. FI selling $10 billion in October so far. Well, that's clearly a painful point. And we have had a heady run. So post that heady run, there is some money being taken off the table. What did the FIs do yesterday? They lightened positions, both on the long as well as on the short side. What did the clients do? Yesterday, after a while, they added more short positions in comparison to the long positions. Though on an absolute basis, the FIs, they continue to remain net short with more than 1.5 lakh contracts on the short side. While the clients, though yesterday, you had the long position that came down from 2.3 lakh contracts, it came down to around 2.2 lakh contracts, but that's still a net long position that you have on the index futures. The PCR, very important. That could be a technical indicator that you'll want to track very closely. It's come down to 0.73. at around 0.65, 0.66, we have seen that the markets do see a bit of a bounce because the call writing gets a little bit too aggressive. And in yesterday's trading session, that's precisely what happened. 24,500, 24,600, 24,700 call. All of them did see a fair bit of aggressive writing that we saw. The Nifty levels we're looking at, yesterday was a weak session, particularly towards the end of trade, because we ended below that 100 DMA. So now we've breached a crucial barrier. The next support comes in at around this 24,000 odd mark. But in case we do see a bounce, you'll want the Nifty to go ahead and breach this 100 DMA. What about the Nifty Bank? That as well has broken a lot of those barriers, the 20, 50 and 100 DMA. So in case we see a bounce, I think you'll have to keep an eye out on the 100 DMA, then the 50 and then the 20. And I think today at some point of time, we are going to see a bounce on the low point of the day. And the Nifty Bank could be the one that's leading the way. It plays out the weekly expiry as well. A few stocks have come out of the F&O ban, so you'll keep an eye out on them as always. The list comes up for you on the screen. You have Granules, IDFC Bank, SAIL, as well as Hindustan Copper. So we'll keep an eye out on all these stocks.
All right, Nigel, thanks very much for that. So keep an eye and, bounce, but the durable bounce actually will take it, right? I mean, we'll see if it's durable or not. But let's just get you some more opinion here. This is Sunil Kaul of Goldman Sachs, who thinks a large price correction in the market is less likely given support from domestic flows. But markets could time correct over the next 3 to 6 months. Consequently, they've tactically lowered Indian equities from overweight to neutral in the Asia EM allocations. They've revisited the Nifty 12-month target of 27,000, which implies a 9% upside, while the 3-month target of 24,500 and the 6-month price target of 25,500, which align with the range-bound or neutral view. Goldman is overweight autos, telecom, insurance, real estate. They've downgraded cyclicals like industrials, cement, chemicals, and financials. Okay, all right. Lawrence Belanco is now joining us. He's, of course, the much-tracked technical analyst with CLSA. Lawrence, great to have you with us here. Good morning. Prashant this side. Thanks for joining in. I think you were expecting larger downsides here on the Nifty and for the Indian market broadly. Run us through your thought process and the levels here, Lawrence.
Yeah, let's just look at what we see on the daily chart and basically the break below the 50-day that we saw at the start of October. We've seen downside momentum now accelerate, and the classic reversal pattern being the head and shoulders that we've seen develop August high, the October high, and then obviously this early October high, forming that formation. And we're really looking for a move back to the 200-day moving average, which sits around the 23,300 area. So we see at least another sort of 5% downside. That'll take the market back to long-term trend support.
Where do we get to, which takes us back to the trend support?
Yep, 23,389. So that's where the 200-day sits, and that's the lower boundary of the uptrend channel of the 2023 lows.
And the market stabilizes there, or you think, I mean, and how quickly? What's the time zone here?
Yeah, so if we look at it, we think into November we'll be hitting those downside targets. So within the next sort of 20 trading sessions, we think we'll be down to those kind of levels. Yes, we would look for evidence of support developing there. You know, the last time we tested the 200-day was the intraday reaction to the general elections, and the prior occasion was actually in the sell-off that you saw in March, April of 2023. So we've only been back to the 200-day, the last 18 months on 2 separate occasions, and we think this will be the third.
Okay, that's a significant downside from where we are. It's over 1,000 points lower, and you see that downside get tested over the next 20 sessions. We've noted that, Lawrence. So let's talk about this leg down that you're still expecting will play out. What looks the weakest to you in India?
Yeah, the sector that we've really been highlighting as where the greatest downside risk is in the PSU space. So if you look at the BSE PSU index, that started to roll over basically from June, July, and since then we've broken down. Yesterday we saw that index break below its 200-day, and that's sort of leading the downside. And if you want to get sort of more granular in this, you can look at the PSU banks versus the private banks. Now, the PSU banks have been great outperformers from the COVID lows up until the start of this year, and since then it started to roll over. So essentially now we've seen private banks hold ground while the PSU banks underperform. So, if we get down into subsectors, but more broadly, PSU is the most vulnerable space here, having broken below its 200-day yesterday.
Hi, Lawrence. Good morning and good to see you.
Good morning.
In fact, the PSU banking index yesterday breached the election day lows as well. So that's one of the first indices to breach those lows. Lawrence, in these sort of times, you're wondering who's going to bat for the bulls, who's going to come in there and support the Nifty. And I believe HDFC Bank could be one of those candidates. What are the levels you're looking out there? It's gone through that long time correction. How is the price action looking?
Yeah, it is probably the most interesting long-term setup that you have within the Indian market. As you say, it's underperformed for the past 2.5 years. It's been consolidating below the 1700 to 1730 area, which we recently pulled back from, but we're now rising back towards that area. So that's really the breakout point for a significant move of over 40% if we break out from that. However, because we think the Nifty does have downside to its 200-day, we think HDFC will remain in this range, but it'll be a relative outperformer. So it is a place that we think you can accumulate here. And once this correction's over, we think we do see the setup for a potential major breakout there. So use the current volatility as an opportunity to build positions in HDFC.
And what are the levels you're tracking on HDFC Bank if it has to break out? I mean, post this consolidation phase, where is it headed? That's the point number one. And point number two is you're clearly bracing for a bit of a correction. What level would it nullify that view? Above what level?
Yeah, so I think let's start off with your last question. The 50-day has been the key resistance zone. When we broke below that in early October, we've had rebound attempts that have failed below it. So really to negate the immediate downside risk, we would need to see the Nifty take back its 50-day, and that currently sits around the 25,150 area. So that would be point one to negate this corrective view of a move down to the 200-day. Your question on HDFC Bank, the breakout area is just above the 1730 area. So clearing above that, holding above that breakout really gets us upside targets of 2,500 plus. So that's where we would see this breakout taking HDFC Bank once we clear through that 1730 area on a sustained basis.
Lawrence, this downside leg, your primary thesis is this 5% down move, right? Testing the 200 DMA. Is this an India-specific move, or are you noticing, some kind of correlation with other global markets as well? Will others also go down, or is this an India-specific move that's ongoing right now?
Yeah, it's quite. We've seen some short-term pullbacks and consolidation, but as far as this tactical topping pattern that I mentioned earlier on, that is an India-specific story, and it's interesting. It really started when China started to rally, and the conversations were, we've seen some rotation out of India back into China, but the weakness and the break of this 50-day has happened with China really just holding its ground rather than rallying. So this does seem to be more of an India-specific story here that we've seen the correction unfold.
Lawrence, you'll be speaking with lots of so-called fast money, right? Hedge funds and those kind of investors. We've seen about $10 billion worth of foreign selling here in India over the last, over this month actually, so far. Is there any sense, any color you can give us in terms of flows, really? What kind, are we talking about a lot of long-only selling? Is it a lot of, hedgy kind of selling?
Well, I think it's a combination, to be honest, right? Initially, it started, the first week of October, we saw selling not only in India, but we saw selling in Japan, as well as bits and pieces in Southeast Asia that was rotating back to China to reduce the underweight positions that a lot of clients had carried for some time. So, India wasn't the only market that was sold down. You can look at Japan too, that was sold down with the rotation going back to the China side. We're not seeing people capitulating on the India positions, but obviously there's a lot of pent-up profits that we've seen with the run-up in India, not only this year, 18 months ago. So we are seeing some natural sort of profit-taking rotation. And the other thing you've got to bear in mind is, coming into a year-end, there is a tendency for markets, particularly in the fourth quarter, to take profits in their winners and look at an allocation to some lagging trades, looking into the new year. So there is a behavioural characteristic to this rotation setup.
Okay, Lawrence, final question before we let you go. The good news from an India perspective is Brent crude prices are still well behaved. Last time you told us you expected to be in that $80 to $90 per barrel mark. Where do you see Brent crude prices headed? And what about gold? Month to month, we're seeing fresh all-time highs.
Absolutely. Gold's uptrend remains intact. We're well past our upside target where we started the year looking at 26.25 as the upside target, and we're $100 ahead of that. there's no signs of weakness there. And I'd advise clients to look at the charts of silver. We've seen a recent breakout this week, and we get upside targets of $40 to 42 and then 44 to 45. So we actually think that silver is a bit of a catch-up trade on that gold setup. And as far as the oil price and the oil price action, nothing really changed on that. We're still stuck within the trading range. And in fact, within that range of the $70 to $90 area, the 200-day sits around $82. And that's where the recent rebound got to and failed. So in fact, we're consolidating in the lower half of that defined range below 82 and above 70.
Lawrence, this last thing, so you said HDFC Bank, you gave us some levels. Any other high conviction trades, either long or short here in India?
Well, I mean, we've mentioned the PSU side, and in our reports, we've been talking about Coal India, we've been looking at Power Finance, and we're looking at Maruti Suzuki as stocks that do have weakness breaking down. Maruti Suzuki closed below its 200-day yesterday. We've been flagging that at least as a take-profit setup. Power Finance has been below its 200 days, as well as Coal India. So there are pockets where we've seen these trading ranges over the past, not only 2 months, but if you look at Power Finance or Coal India, a number of months that upside momentum slowed, and you've started to break some of those longer-term trends already.
Okay, so a couple of more names perhaps on the downside, and maybe something like an HDFC Bank could emerge stronger once all this is over. Lawrence, thank you very much for joining in. That was really helpful, and we look forward to more conversations in the coming weeks as well. Well, that's a big view coming in from CLSA on the charts, on the technical, saying that the correction isn't over. There's another leg down, and probably it could be 5% lower when the Nifty tests the 200 DMA. All right, so with that view behind us, let's now move on and talk about what else you can catch on the show today. A lot of corporate interactions lined up as always at 8:40. We'll get chatting with Manish Nandan of Zensar Technologies, talk about their second quarter performance. At 9:05, we'll have Karan Taurani of Elara Capital to talk about Zomato's fundraising plans and also, of course, the Q2 show. At 9:20, we chat with our market master of the day, Karthik Kumar of Axis Mutual Funds, join in. At 9:30, the management of Coforge will discuss their second quarter performance and the outlook ahead. After that, we have Devansh Jain, Executive Director of Inox JFL Group, to talk to us about their recent business updates. A little later, Priyankar Biswas of BNP Paribas joins in to talk about expectations from the capital goods sector in the earnings season. And finally, at 10:10, Lata will be in conversation with Nitesh Ranjan, the Executive Director of Union Bank of India, to talk about the second quarter outlook.
Well, time for a quick break, but a lot of stocks we're going to be tracking for you on the other side. For the time being, run you through our top 10 list. We're looking at Max Financial, Canfin Homes, Persistent Systems, Indus Stars, Amber, Coforge and Paytm. All of them will be reacting to positive news flow, while you have Bajaj Finance, ICICI Prudential and Mahindra Financial that will be reacting to negative news flow.
Welcome back. So we've got the global setup and we've discussed some levels with Lawrence as well. Now let's talk about individual stocks that need to be on your radar. Lots of earnings pouring through, and our team is standing by with the CNBC-TV18 list of top stocks to watch today. Guys, good morning to all of you. Abhishek, let's start with those big reviews from the BFSI space, starting with Bajaj Finance.
Well, stress has increased for Bajaj Finance, and they have increased their credit cost guidance as well. So to begin with, Bajaj Finance has raised their FY25 credit cost guidance to about 2.05% from the earlier guidance of about 1.75% to 1.85%. So it's a 30 basis to 20 basis point increase in the credit cost guidance for FY25. Provisions have increased 77% YOY and about 13.3% sequentially. Perhaps for the first time in many quarters that I'm seeing their credit cost on a quarterly basis, annualized credit cost being above the 2% mark. So it was at 2.13% versus 1.99% in the previous quarter. Now, company had a gain, one-time gain from the stake sale that they have done in Bajaj Housing Finance. So about 2,500 odd crores with respect to net realization is what they have got in this quarter. With respect to their asset quality, gross NPA absolute value has increased by 29.4% on a quarter-on-quarter basis, and as a ratio, gross NPA ratio has inched up to more than 1% for the first time in many years. So it is now at 1.06% versus 0.86% in the previous quarter. With respect to the PNL, both the NIs have beat on our poll, but elevated provisions has meant that the PAT is below our poll. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Yash. He's got a couple of companies that he's tracking, namely ICICI Pru Life as well as Max Financial. Morning, Yash.
Morning, Nigel. So I'll start with ICICI Prudential Life Insurance. It's a weak quarter which has come through for the company. If you speak about the numbers and summarize them, it's a top-down miss. APE, VNB and margin, all three numbers are below what the street was working with, below what CNBC-TV18 poll had suggested. To start with, new business premium, that has seen a growth of 14%. It is in line with CNBC-TV18 poll. The number is 4929 crore. The number that we were working with is bang in line, 4929 crore. Total annualized premium equivalent, that has grown by 21%, but it's a miss when it comes to the estimates that the street was working with. The number is 2504 crore. The number that we were working with was 3,139 crore rupees. Retail AP seen a growth of 26% on a year-on-year basis. It's in line with CNBC-TV18 poll at 2161 crore rupees versus 2108 crore rupees. Value of new business, there's a big miss which has come on the VNB number. It is grown by just about 1.5%, and as far as the numbers that has come through is 586 crore rupees. The poll was 758 crore rupees. Speaking about margins on a year-on-year basis, the margins have seen a downtick of 458 basis points. It has come in at about 23%. The number that we were working with in terms of our estimates was 24.14%. Now, speaking about Max Life Insurance, it's been a good quarter for the company. You speak about new business premium, that has come in line. Apart from that, total AP, retail AP and VNB margin is ahead of what the street was working with. New business premium seen a growth of 25%. It is in line with a poll at about 3016 crore. Total AP, that has grown at 31%. The number that has come in is about 2,170 crore. Our poll was 2,111 crore rupees. Retail AP, that has seen a growth of 26%. Value of new business, to speak about that, has grown by about 23%. It is much ahead of the poll that we were working with. Margin has also come on the higher side when it comes to Max Financial Services.
All right, Yash, thank you very much for that. So that's insurance in focus. Canfin Homes and M&M Finance are the other two. We're going to go back to Abhishek on. Abhishek, good morning. Take it away.
Good morning, Prashant. So to begin with the Canfin Homes, for the first time in last 9 quarters, the growth rate with respect to AUM on a YY basis has been arrested from the declining trend that we are used to seeing over the last 8 quarters. So AUM growth is about 9.6% YY and about 2.8% sequentially. They have improved their net interest margin to 3.75% versus 3.57% in the previous quarter. Asset quality has remained stable and gross NPA ratio has improved to 0.88 versus 0.91% in the previous quarter. With respect to the PNL, NI is at 340 crore versus Kotak Securities estimate of 328 crores, while PAT is at 211.5 crore versus Kotak Securities estimate of 210 crore. With respect to M&M Finance, now their guidance X of gross NPA has been revised lower across various parameters. So to begin with, FY25 guidance for gross NPA has been put down to less than 4% from the earlier guidance of less than 6%. However, net interest margin guidance has been cut to about 6.5 to 6.7% versus 7.5% earlier. Growth has been pulled down from 2x of AUM to 1.8 to 2x AUM. OPEX to assets, that ratio was stated to be less than 2.6%, but now it has been revised to 2.6 to 2.7%. And the new business target that they had set for themselves was about 15% of AUM, but they have reached only 6% of the AUM, and management says that there is more work to be done over here. The return on asset, that's disheartening to see. That target was set at 2.5%. It's been now reduced by about 50 to 70 basis points. The new target being 1.8 to 2% for FY25. So on balance sheet loan growth of about 20% is perhaps the weakest loan growth that you are seeing in last 9 quarters. Disbursements have declined YOY for the first time in last 13 quarters. Asset quality has deteriorated. So gross NPA in absolute value has increased by 13.7% sequentially, as a ratio also is inched up to about 3.83% versus 3.56% in the previous quarter. Even their housing finance subsidiary that's seen a deterioration in asset quality, wherein the gross NPA ratio has inched up by 30 basis points sequentially to 9.14%. Back to you.
All right, Abhishek, thanks very much. Let's see if M&M Financial Services becomes the stock of the day, but for the wrong reasons today. Watch out for this one. But on to some happier numbers. Amber, Upasna is looking at this one. Good morning, Upasna.
Good morning. Amber Enterprises reported strong set of numbers. Revenue and PAT came above poll estimates, while EBITDA margin was in line, and the strong performance was mainly driven by strong REC demand and low channel inventories. Now, revenue stood around 1,685 crore with an uptick of 82% on a YoY basis, and REC revenue grew by 104%. While non-REC component grew by 68% on a YoY basis. Company's margins came in at 6.7% with an uptick of 30 basis points on a YoY basis, and PAT stood at 19.2 crores versus a loss of 6.9 crores. So all in all, strong set of numbers reported by Amber Enterprises in its Q2 FY25.
All right, thanks a lot for that, Upasna. Well, let's go across to Rima. She's here to tell us about Coforge. Rima?
So Coforge has reported a good set of numbers. You know, the performance has been boosted by the Cigniti acquisition. So reported revenues have gone up 26%, but even on an organic basis, ex of Cigniti, we've seen a top line growth of more than 5%, 5.5%. Margins, though, have come under pressure because of higher, depreciation and amortization costs related to the acquisition. But the key positive is the new order wins. So the order wins are very strong, growing more than 40%. So strong organic revenue growth, very good order booking, and that's why I'm going to go with green for Coforge. There's a conference call which is currently going on.
Well, Rima, thank you very much for that. But Persistent reported numbers as well, and those were really good, right? What about Indus Towers as well? Yeah, go on.
So Persistent was a beat on revenues and margins. This is a company which is seeing very high growth, the fastest in the industry. Top line growth this quarter came in at 5%. They've maintained their margins. Deal wins continue to inch up, 14% up. And the company in the conference call reaffirmed their FY27 guidance of achieving $2 billion in revenue. So strong for Persistent. Only thing is valuations are much higher than peers. Indus Towers, the key positive in Indus Towers is the margin improvement. Margins for the company went up from 61 to 65%, and this is because the company has managed to recover some old dues from Vodafone Idea. So that was to the amount of 1,080 crore that boosted the company's margins, which is why, despite just a 1% revenue growth, the company's profits went up by 15% sequentially. Back to you.
Okay, all right, got it. Rima, thank you very much for that. Let's quickly move on and go to Ritu. There is an update on Paytm. The company has been allowed to onboard UPI customers once again. Ritu, morning. Tell us more.
Good morning, Surbhi. We're going with the green for Paytm because the NPCI has granted, the parent entity 197 Communications the approval to onboard new UPI users. And this comes nearly 9 months after RBI had barred them from adding any new customers. But the approval, of course, is contingent on them adhering to all regulatory guidelines and NPCI norms. Now, keep in mind, Paytm's UPI market share had taken a hit during this 9-month embargo, and it dropped from about 13% in January to 7% in September, although Paytm remains the third largest player in the UPI ecosystem. Now, OCL had earlier got an approval from NPCI to operate as a third-party application provider with about 13.5 crore UPI customers already migrated onto this new OCL platform supported by the 4 banks. Now, this nod to onboard new users is going to lead to an increase in UPI transactions volumes for the company, and it will allow them, importantly, to cross-sell financial products as a distributor. In fact, yesterday you had founder Vijay Shekhar Sharma speaking about this very opportunity that UPI presents for Paytm during the earnings con call, emphasizing that Paytm was not here to become just another mediocre or fringe player, but to solve for the problem of concentration risk in the UPI ecosystem.
Okay, all right. Well, some good news definitely coming in over there. We'll see how the stock reacts. Thank you for that, Ritu. Let's quickly recap our list of stocks to watch today. The ones that have positive news flow around them are Max Financial, Canfin Homes, Persistent Systems, Indus Towers, Amber, Coforge, and Paytm. Stocks with negative news flow around them, Bajaj Finance, ICICI Prudential Life, and M&M Financial.
Okay. Okay, well, that's essentially the list of stocks to watch, but we're going to address one more, and this is Gujarat Fluorochemicals, and I think this is a we told you so moment, not for me, but for Nimesh. The Gujarat Fluorochem subsidiary has raised 1,000 crore rupees from getting investors into its chemical battery business. Now, Nimesh had highlighted this as part of his D Street chatter, and the chatter is now reality. Nimesh, morning.
Morning, Prashant. So it's official now that the Gujarat Fluor in its subsidiary business, which is GFCL EV, they've raised 1,000 crores at an equity valuation of 25,000 crores. So it's a big deal. They've raised money from some marquee large family offices. They've not mentioned the name of those investors. The funds will be essentially used for capex. Now, the EV battery chain opportunity is estimated to be $300 billion by 2030. So that's a large TAM that Gujarat Fluor can address through. Now, if you look at the subsidiary business, one, the battery chemicals, second, cathode active materials, and third, the binders. So it's a significant development. I'm saying significant because the Gujarat Fluoro's market cap is 50,000 crores. Development. The only caveat here is, Prashant, the stock is rallied pretty hard. The first time when I highlighted, the stock was at 3,400. Now it's almost at 4,700. So in the price to some extent, some large market investors.
All right. Thanks a lot for that, Nimesh. Bang on yet again. So good one with regard to Gujarat Fluoro. But let's move to Manisha about what's going on in the commodity market. Manisha, morning.
Morning, and thank you for that, Nigel. When I'm looking at all-time highs yet again for gold and silver prices, overnight has been great moves on the higher side here. So when you look at the gold prices, we have seen 20 here. For the silver prices, overnight gains have been to the tune of 3%. International markets are trading at a 12-year highs, but the Indian markets have hit a lakh rupees a kg for silver. Strong gains is what we've seen come back for the crude oil prices, almost 2% of gains in the overnight market. This is after there have been some reports suggesting that we perhaps are looking at tight see crude oil prices decline by 7%. So some buying opportunity on the lower side is what we are looking at in sense of prices.
All right, break, but we're going to leave you with some good news as we slip into this break. 1 million Indians are now making smarter investments with the help of Money Control Pro. Money Control Pro, which is part of the listed entity Network 18, has crossed nearly 30% higher than its closest competitor, Economic Times, underlining the decisions. If you haven't subscribed yet, scan the barcode on your screen now to be
Welcome back. You're tuned into Bazaar Morning Call. Hope you're having a good morning and hopefully today's better than yesterday. Well, to help you out with some fundamental analysis, Deven Choksi, the MD at DR Choksi FinServ, joins us on the show. Hi, Deven. Good morning and good to see you. Well, let's start talking about Bajaj Finance. Well, that one has gone through a time-wise correction. It's practically not done anything of the recent past, and the numbers were a little bit subdued. What's your view on the stock?
Yeah, good morning. Overall, I think the loan growth continues to remain healthy. On the other side, I think the pressure is appearing on the margin, I think largely because of the higher amount of credit costs. In my viewpoint, I think this is a passing phase. I think till the time the rate gets adjusted, I think you are going to see this kind of pressure continuing for a couple of quarters. Fortunately, in the second half of the financial year, we are seeing a strong demand growth emerging in the economy. Particularly for the business of Bajaj Finance, where I think the consumer credit growth is likely to be much sharper and much better going forward. Should the cost of fund gets adjusted in the price that they are charging to the customer, I think the mean pressure will eventually come down. But maybe the December quarter is not likely to see that situation. So one will have to wait and see. Overall, I believe that the performance of the company remains in line with growth trajectory in which the company is operating. The different verticals in which they are lending the finance, including the new age verticals, including the storage batteries. Probably, I think this is going to be a new game which is going to be played by likes of Bajaj Finance, where probably you are likely to see the larger portfolio emerging out of even the financing of batteries, for even vehicles. We like, this particular proposition for the company going forward.
Devin, hi. But it's not only Bajaj Finance, right? I mean, from banks to other lenders. M&M Finance yesterday, all the headlines coming out that Abhishek was telling us were very, very weak. I mean, they've downgraded guidance across the board on many parameters. Credit costs stress is there, and they'll probably look at slightly lower growth as well. On M&M Finance in particular, what would you advise?
Yes, good morning. Well, I think my understanding is that a couple of quarters will go in repairing the balance sheet. I think this company has had past, where probably they need to correct it. I believe that the new team out there could possibly, start cleaning up the books first to begin with, and then the revival and the growth will emerge. Maybe we'll want to see the result of December and quarter, and if required, in the next quarter as well, to establish the fact that the balance sheet cleanup work is happening or is getting over. Till that point of time, we are going to see the overhang of the higher provisioning into the books as well. And that would possibly keep the profit performance which was subdued in the coming quarters.
All right. I think Deven, today is going to be a very big day actually in terms of earnings, because I think you have HUL, you have Pidilite as well, and TVS Motors, all economy facing stocks. So irrespective of the numbers, you'll want to wait by for the commentary as well. But let's take a break from, the results. I want to ask you about NMDC. And the news that's come in this morning is, after hiking prices by 400 rupees at the start of October, they've gone and increased prices by another 600, another 400 rupees per ton. What's your view on the stock? Because the second half of the year is traditionally better than the first, which means steel demand will, move up. And in turn, iron ore, production and prices both looking up. Your view on the stock?
We remain distinctly positive about the entire sector as a whole, Nigel. And I think in particular, the ferrous and non-ferrous commodities, we believe that the steel commodity could possibly look up smartly. As you rightly alluded, saying, the second half of the financial year, we are seeing the demand growth also happening. I think government projects are getting executed in this particular period. And considering the fact that this time around the full budget came in after 1st July, I believe that the growth will continue to be, smarter and bigger in the second half of the financial year, where the steel commodities could probably look up significantly. Fortunately, the price stability has come because of the China stimulus decision. And as a result of which, some of the companies would probably have the advantage of fetching the better realization. Of course, structurally, we remain bullish on the steel sector and also the metal commodity sector, because we believe the blend of renewable energy along with the conventional energy will bring down the cost eventually, subsequent years of the energy, and that is protecting and growing the profit margin for this company. So we remain bullish on this particular space as a whole, and I think some of these companies in particular.
Devin, finally, before we let you go this morning, a word on the mid-cap correction that's underway, right? Severe damage yesterday to prices. Stocks are falling 10, 12, 13%, particularly a lot of the PSUs. What would your advice be? On PSUs, I think a lot of people are also rushing to just book profit, because the margin on that profit is now coming lower. The stocks were down about 20%, now 30, 40% from the highs. So what's the advice on the PSU pack? And in specific, would you look at buying anything, any one or two names on the mid-cap side? A chart has just told us the correction will probably extend for another 5% down. Would you look at buying anything now?
Yes, so I think the correction is not over. Probably the market has started realizing that the valuation against the underlying growth has been far more steep and far more expensive. Given that kind of a situation, till the time the valuations get corrected, maybe the price correction may be fast, time correction will be slightly longer. If that valuation do get corrected, in my viewpoint, I think that would become a buy opportunity. As of now, I think we don't have immediate buy recommendation on any of the PSUs, though we have always believed that the PSUs are great business. However, I think you have been giving significantly large valuation in the market, and that's where the correction is due. We'll have to wait and see when I think one can enter. Definitely, we like some of the stories, particular visibility some of the defense companies have created in form of higher amount of order book and its execution. Certainly, if the price comes down and the valuation becomes attractive, one will look at buying them at a later date. But as of now, immediately we don't have any particular recommendation to get into.
Okay. All right. We'll keep that in mind, Devin. Thank you very much for joining in. You have a good day, and we look forward to connecting again soon. Well, it is earnings season, so let's quickly get a couple of those earnings calls going. Then Zensar Tech is the first management on the radar this morning. The company reported a steady set of numbers for the second quarter. Furloughs in telecom media actually did drag growth to some extent. Margins did see a jump of about 20 basis points sequentially. Zensar has seen the highest ever deal wins at about $202 million. Joining in to talk about the results is Manish Tandon, MD and CEO at the company. Manish, good to have you on. Now, second quarter was, okay. There was growth, but it was still subdued. And I think you're talking about furloughs, especially in your verticals like telecom, media, and tech. So what is the overall loss in the revenue in Q2? And will you make up for this in, say, Q3, Q4? Can you give us some visibility?
I think, first of all, the overall performance of the company has been very good at 156.2 million. We saw 1.2% sequential quarter-on-quarter growth. If the furlough, there were two impacts that I had talked about last time also. The one was the impact of furlough and a couple of clients, and the other was the security breach because of CrowdStrike also shifted some money away from a couple of clients, from us to security, this thing. And if I were to look at that overall number, it would be close to $3 million that we lost because of these two issues.
Well, Manish, quarter three of last year saw negative growth of around 3%. Are we looking at negative growth in quarter three yet again?
Well, there is always a possibility of negative growth. But as a management team, we have said that we will try to make every quarter count and try and show positive growth every quarter.
What's the margin outlook? You've managed a 20 basis points improvement in this quarter. Second half, what kind of margins are you estimating?
We have, first of all, we improved our margin in Q2 despite giving salary hikes in time. And so our EBITDA margin has improved from 15.2 to 15.4 overall. And we have always said that we'll try to maintain margins in a tight range in mid-teens, and our commentary still remains the same.
All right, Manish, there was a sharp jump in deal wins. What led to it, and what is the pipeline ahead?
Well, I think we had our in terms of order bookings, we had our best quarter ever, and I think for the first time we have crossed 200 million in order bookings this quarter. This is good execution, I would say, and good differentiation in the market. Pipeline is okay. I would say is good. A couple of large deals also that we are working on. So overall, I'm positive that we will be able to do okay on this order bookings and pipeline also.
Okay, can you also share some more color on the individual verticals? Your TMT, this telecom, media, tech. This has seen quite a decline, right? 8.5% Q-on-Q decline. So when does it come back to growth? BFSI is looking better this quarter. So can the improvement there sustain?
I think except for TMT, all the sectors have continued to show growth for us. And that is a very positive sign. Now, I have been asked this question that, have we seen the bottom in TMT and all? And I'm telling people that even when your clients don't know whether they have seen the bottom or not, then how can you expect me to comment whether the bottom has been reached or not? And as I said, my commitment always has been that irrespective of the sectoral performance, I would continue to show sequential growth quarter on quarter. And by the way, this has been the case except for one quarter that you're talking about. Except for that quarter, over the last 6 or 7 quarters that I have been there, we have been very consistently exceeding that number.
Okay, Manish, appreciate you stopping by and speaking to us here on CNBC TV18. Wishing you a good day ahead. We look forward to chatting up with you to see how the year is progressing in the coming quarter as well. For the time being, we'll slip into a short break. On the other side, Mitesh and Sudarshan, they're waiting for us with their technical calls. Don't go anywhere. Welcome back. As promised, let's go to our technical guest. We have Mitesh Thakur and Sudarshan Sukhani who join us this morning. Good morning, gentlemen. Thanks a lot for joining in. Well, Mitesh, let's come across to you first. The last few sessions, you've been sounding very cautious at the start of the trading session. And when I asked you at around 2:30 as well, still you sound quite cautious. And that call actually has proved right because the Nifty has pulled back. Where are we headed now on the Nifty? And what would your positioning be at around this 24,500 mark?
Yeah. So I think the weekly structure, has been weak in the sense that the charts have turned negative. The indicators are now looking on the downside. And therefore, I think, you are seeing such kind of a strong supply emerge and every rally is getting sold into. My sense is that I think, the next few weeks might be spent in a choppy correction consolidation kind of movement, wherein you will get declines on you'll see a lot of supply at higher levels and on rallies and pullbacks. And I think till some kind of a significant base building happens, I'm not looking at a reversal. Yes, you can get bounce backs and pullbacks, but for me in the short term the texture is negative, so these bounce backs will be used to sell into it. The key level on the upside was 24,750, 800, which is holding very nicely. So any pullback to those levels, I think, would be the first level where I would want to add on to short positions, though we have taken some profits as well yesterday.
Got it. Okay, all right. Mitesh, quite clear on that. Sudarshan, what about you? Would you also be shorting the bounces, or do you think we're closer to the lower end? So in case you get an intraday dip, you look at a counter trade?
Yeah, good morning. Actually, I don't usually recommend short positions in the Nifty or even the Bank Nifty, simply because the overall trend of the market is up. And it's not easy to catch these shorts except for a very professional trader. So the trade usually is, if you are not long, then you are on the side. Don't take any trade. That was my view for the last 2-3 days. That continues. The only way we will know that this market is finding a base or building a base is when the market starts going up. Otherwise, levels are of no use. Every level is being broken one by one. So the view is wait patiently for a couple of days, more days, for the markets to actually start going up, not just stay here. Once the market shows upside momentum, then consider buying. That's unlikely to happen today. So today is a stay away day.
Got it. All right. But Sudarshan, you'll have individual calls on stocks. So let's get to that.
Yeah, sure. I have 2 intraday shorts. Short selling should always be done intraday. PEL is an intraday short with a stop above 1,050. Divi's Lab, so the same group, same sector, is an intraday short, stop above 59.50. For some reason, pharma seems to be getting ready for a correction. Jubilant Foods is bottoming out. Now, that may or may not happen in this market. It's worth finding out. So buy Jubilant Foods with a tight stop under 610. And yesterday's high flag come City Union Bank continues to be a buy with the stop under 161.
Okay, all right. Thanks for that, Sudarshan. I'll tell you what, we'll slip into a short break, but Mitesh is waiting to give us his picks on the other side of the break. So don't go anywhere.
Okay, welcome back. Just a couple of seconds to a couple of minutes to go for the market open, 12 minutes actually. The pre-open is kicked off, and I think the first rates are in on your screen at the bottom of the screen. Oh, I don't think we'll get a 240-point lower start. So let it adjust a little bit. It'll settle down to much more flatter, maybe sideways kind of market. That's essentially was the indication from the GIFT Nifty as well. But well, lots of news flow. And this is, let's talk about Zomato first up, right? I mean, they've, okay, I think what we'll do is, Karan Thorani is going to join us on Zomato in just a bit. But Mitesh is with us and Sudarshan as well. Mitesh, morning. Your trades for the day?
Yeah, I have more of sell calls today, but on a level specific basis. So Glenmark is a sell if it breaks yesterday's low of 1676, keep a stop at 1695, look for targets of 1635. Coal India on a bounce back around 472, 473, take a short position with a stop at 479. And here the first target is 460 on the downside, and a sell on Atul Limited around 74.60, 74.80. So again on a mild pullback, keep a stop at 75.51. Look for targets of 72.50, and one buy call, that's Axis Bank around these levels of 11.75, 76. Buy with a stop below 11.55 and a target of 12.10 can be looked at.
Got it, Mitesh. Thanks a lot for that. Well, let's focus on Zomato then. Yesterday, that fundraise was announced along with the numbers. We'll get to Karan Thorani in just a bit. But for the time being, let's go to our in-house expert. Mangalam joins us to run us through his quick analysis on that. Mangalam.
Well, the results for Zomato weren't particularly bad, but they are indicative of an impending competitive intensity in at least the quick commerce space. So if you just take a look at the numbers, good part was 55% growth in the B2C business, GOV growth, that is, adjusted EBITDA came in at around 330 crores versus 41 crores. Food delivery, there too, the gross order value grew 21% year on year. Quick commerce, GOV actually doubled year on year with a 122% gain, and going out business, which is a business that the company is seeding going forward, is up 171% as well. The reported revenue for Blinkit was up 129% at 1156 crores. The EBITDA loss out there contained to 8 crore versus a loss of 125 crores same time last year, and they have around 791 stores. This compares with 411 stores as well. On the District app, the company said it would be live in the next 4 weeks. So the key to track now will be how the District app sees traction once it is launched. And secondly, competitive intensity in quick commerce. Why do I say that? Because they have announced a $1 billion fundraise. And everyone's asked, why raise this fund when you have over 10,000 crore of cash on their books? On that, the company said they need to enhance their cash balance given the competitive landscape. They want to ensure that they are on a level playing field versus competitors. And quick commerce continues to operate at near adjusted EBITDA break-even, but they would just like to have a little more cash on their books. The good part is they've assured the street that there are no plans of any minority investments or acquisition, but this is just them strengthening their balance sheet beyond what it is already.
All right, Mangalam, thank you very much for that. Karan Thorani is now joining us, Senior Vice President, Research Analyst at Elara Capital. Karan, good morning. Good to have you here. Prashant this side. Again, we heard from the management themselves in terms of the reason behind fundraising. But again, I mean, it is still exactly what this is going to be used for. Is this, as someone put it, posturing? Is this a little opportunistic? Or this is to do with having regulatory options in terms of how they operate in the marketplace? What's your sense, Karan?
Hi, Prashant. Good morning. So I think the fundraise, it's very clear now that it is not for any kind of acquisition. I think this is largely in line with our view. 2-3 reasons here. I think the fundraise, the first part is, to kind of take advantage, of the situation with Swiggy IPO being around the corner. There is a lot of interest, for these high growth companies. And if the times are favorable, they would go for this kind of a fundraise and make the most of this opportunity. The second part is, in terms of the potential war chest, right? So we have quick commerce is now becoming a very big segment. It will scale up beyond the metro cities also potentially, and we don't know in terms of what verticals will click, how much of investment will be needed in this segment. So very clearly, they want to have a cash balance which is ahead of market, ahead of competitors, because they are the market leader in this space. And the third respite is that they very clearly mentioned that they will not use this cash to, discount and, kind of, make sure that growth rate, they want to focus on user experience and not just purely in terms of discount. So these three things are like some sort of a respite in terms of the, the fundraise that they're trying to do. And I don't see any potential negative impact, because of this so far.
Okay. Got that. Karan, morning. Good to have you on. Let's also talk about the second quarter numbers, and they're just looking better quarter on quarter, right? I mean, the improvement continues on the profitability side, on the GOV numbers. And I was looking at the details that Mangalam had shared. I mean, on quick commerce, I think the growth is well over 100%. So how do you map the trajectory from here on, given the stock price level? Because the stock has also rallied. So just run us through the growth and valuation dynamic here for Zomato.
So I'll come to the food business first. I think the growth rates there have been largely in line. Of course, it's moderated since the last 3-4 quarters. We've seen growth rates of beyond 25%. So that's kind of moderated. But I think that's part and process. I think we don't expect more than 20 to 23% growth in GOV in the food segment on a steady state. Margins again are largely steady on a Q1Q basis, but they are improving since the last 8 quarters, since we reached break-even point. Today they're at 3.5% as a percentage of GOV. So clearly traction in the food segment continues to be there. I don't think there's an issue in terms of food business or them kind of potentially losing market share for now. So, and in terms of valuations as well, we do see that this business can trade at about 80 times P and about 55 times EV/EBITDA basis execution. So two things to watch here would be the consistent growth rate of 20% plus GOV in food going ahead, and also the improvement in terms of margins towards that 4 to 5% band that the management has guided for. On the quick commerce side, it's very clear that they want to really gain market share here, and that's why the aggression in terms of adding more stores versus the peers, and they are on track for that as well. So growth rate in quick commerce remains to be good. Take rates are largely stable. That's primarily because of store expansion. Two good things in the quick commerce is that one, of course, the losses haven't increased, despite this heavy store addition that they've done over the last 2 quarters. So that is some respite. Second good news is that the new stores that they're adding, they are somewhere closer to 70% of their portfolio in terms of average throughput per day. So clearly the new store addition is, kind of generating good order volume, good traction, and this is not coming at the cost of, losses going up. The break-even point is maintained. So I think it's good news for both the food and the quick commerce business. Execution remains to be on track.
Okay, all right. Hi, Karan. Good morning. Good to see you in. Karan, the valuations between Zomato in the listed market and, there's a lot of action in the unlisted market. So how does it weigh between the two right now, Swiggy versus Zomato?
So I think Swiggy valuations, as per some media reports, are pegged at about $11.5 to $12.5 billion. I mean, we don't have it under coverage, so we'll refrain to, comment on that front. But I think given the kind of, the metrics that Zomato operates versus Swiggy, given the kind of market share numbers, given the kind of, a higher AOV, higher customer base, higher scale, better profitability, better track record, better execution, I think, I would still prefer a Zomato versus Swiggy for now, because clearly, I think in terms of track record, they've been far superior. And whatever challenges we've seen so far is all external led. This, Karnataka government kind of raising some kind of 2 to 3% higher outgo for gig workers, some kind of regulatory impact because of this Consumer Good Association going to CCI. These are all external measures, and they will have a negative impact on the company in some or the other manner in terms of the earnings. But internal execution remains to be on track and remains to be strong. So we'll still, go with a Zomato over a Swiggy for now.
What are the current market share numbers? What are your channel checks indicating? How much is the gap between the two? And also, what would be your comfort valuation range for Zomato? I mean, how much more would you give it?
So I think in terms of the market share numbers on the food side, Zomato is about 20-25% higher market share versus Swiggy. They're at about 50% plus kind of market share on the food side. On the quick commerce side as well, if you look at Zomato's market share, they're at about 30-35% higher market share versus Swiggy as well, despite them entering this segment much later, after Swiggy. So clearly that edge remains. And I think in terms of valuations, we are almost near to the bottom now. And I think at price levels of 240 levels, these kind of markets where everything is falling, Zomato will be the very good price to accumulate, because 6 to 8 months down the line, once you roll over, our target price of 320 can potentially become over 400. So clearly, it's a good time to accumulate this stock, at these levels.
Okay. All right, Karan, we'll leave it on that note for this morning. Thanks very much for joining in and giving us some perspective over there. Just looking at the pre-open trends now that things have settled, well, 93 points down. That's what the pre-open Nifty is telling us, at least as of now. And talking about some of the movers and shakers, so Shriram Finance, HCL Tech, Lever, a lot of these stocks are on the way down. I'm just checking the rate on Bajaj Finance, 1% lower. That's what the pre-open is indicating. So yeah, probably off to a bit of a soft
Maybe
start.
just look at Sudarshan, of course, is also going to be with us as well. I think Sudarshan is with us. So 9-10 calls with both Sudarshan and Mitesh. Sudarshan, you go first.
Well, consider intraday short in PEL with a stop above 1,050.
PEL, got it. All right. Thanks for that, Sudarshan. Mitesh, what about you?
Well, if the Glenmark trades below 1676, take a short for targets of 1635.
Okay.
Got it. All right. Thanks a lot for that. Thanks a lot for that, gentlemen. Just one thing, Prashant, on a day, when you see a sharp decline and if you're looking to buy the dip today, that dip has come. Sometimes it's very tricky when the market bounces the next day, because that gives, the bears a perfect opportunity to come and short to that. So I think getting a 100-point downtick at the start of trade may not be such a bad outcome actually from a bullish perspective. And hopefully there is some kind of a short squeeze that's in the works.
Absolutely. If the market's got to go up, then you better start lower. Well, visuals coming through. Money Control has achieved a very significant milestone, and we want to sort of make a big deal about it, because it is a big deal, right? I mean, they've crossed the milestone of 1 million paying subscribers. They've created history, 1 million paying subscribers, right? Now, that's 10 lakh in number, just to sort of put those numbers in stark view. It's not just this. Money Control has also strengthened its leadership position once again, surpassing the Economic Times with 53.16 million unique visitors in September. That is a 30% sort of higher number as compared to the ET. 1 million Indians are now making smarter investments with the help of Money Control Pro, which is part of the listed entity, which is Network 18. You've got the sort of head of Network 18, Rahul Joshi there, our colleague from Money Control, Mahalakshmi, and of course we've got the NSE boss, Ashish Kumar Chauhan, sort of bringing in the market opening this morning on this historic occasion. So there you go. We've got the sort of levels on your screen, and of course the bell going off there as well. So that's Ashish Kumar Chauhan and Rahul Joshi bringing in the market open on this historic occasion. That is really something to sort of look at. Well, the market's open and we're down about 25 points. 24,440 is where we are starting, and you've got that's a 40-odd point lower start. Bank Nifty is starting about 25 points with a 30-point cut. It's actually absolutely flat, nothing at all. And the sensex is down about 100 points as well. You've got the IT index, which is starting about 0.65 higher. Advanced decline is kind of, more in favor of declines. But of course, by close yesterday, it was very, very, very poor. 10:1 in favor of decline. So it's more evenly balanced still. And today, of course, is going to be a lot about individual stocks, earnings reactions and otherwise. So let's get to it. Surbhi.
Yeah, straight away when I'm looking at the early casualties, M&M Financial and Shoppers Stop. Remember the loss of 20 crores that Shoppers Stop has posted this quarter. Those are two names that are down straight away. But, the large cap picture is not that bad. Remember, in the pre-open, we were looking at a 100-point cut. Well, it's a 25-point dip right now. If we talk about where the losses are coming in from, it's M&M, Power Grid, Eicher Motors, BEL, there's BPCL, the cross-sectoral lines really. There's some PSU selling going on, some auto selling going on. Lever is not in a good mood ahead of numbers, 1% down there. L&T is lower, SBI is lower. A lot of the heavyweights are on the way down. What is offering a bit of a counter, Bajaj Finance's reaction is really, really interesting. The stock was down 1% as we started, but the management is saying that this is probably the worst of the credit quality issues and this is it. It gets better from here. And maybe the market wants to kind of buy into that. I saw some brokerage reports that still have a 9,000 rupee target on the stock. It seems to be a, keep the faith, buy this dip sort of a moment for Bajaj Finance, and we'll get more analysis on that going as we go forward. Finserv is also up and about 2% higher. That's Bajaj Finserv. Bajaj Auto is up about 0.5%. So a lot of Bajaj names right on top. HDFC Bank continuing its good form from yesterday. So there's more gain there, 0.5% higher. And then some of the IT heavyweights are offering a good counterbalance this morning. TCS, Infosys, Wipro, a lot of these names on the upside. So basically, you've got tech to the rescue. HDFC Bank still fighting, standing tall. And Bajaj Finance is a real good flip in this, in the morning. So the bull and bear tussle goes on. At least on that one stock, the bulls are having their way.
120 seconds into the trading session and we're back in the green. So not such a bad outcome because we started off with a cut-off closer around 100 points and the bulls were like this actually. Now building onto these gains are very, very important. And by the way, this reaction on Bajaj Finance, this is heartening to see. This is something that the bulls is really looking forward to. I'll tell you what, if you can get some kind of a positive surprise in the commentary from HUL, Pidilite, TVS Motors, this market will take it very, very positively because that's something that has been missing. Stocks that are moving around though, the Bajaj group itself is doing well. So auto is up, Finserv as well as finance. So those are the top movers. From the metals pack, NMDC have gone ahead and increased prices by close to around 400 and 600 rupees per ton. The street likes that. The stock was down 6% yesterday. It's bounced back close to around 4% today. GMDC, the numbers are quite good. And, on a lower base, though. So that stock as well has opened up the gain of close to around 2%. Joe, from the recent peak, I think the stock is down close to around 35%, but it's up 4% to kickstart trade. So good going out there. A couple of other big movers. Genesis International, I'm not sure what's happened there, but that one's up more than 10% in today's trading session. So massive move is what we're seeing on that one. And a couple of earnings surprises. So good to see. Max Financial, Amber Enterprises, both of them up 6% apiece. You have Wockhardt as well that's bouncing along. And Olectra Greentech, if I saw that correctly, that stock as well has opened up with solid gains in today's trading session. 24,500 is here. So good to see a 150-point bounce from the lows. And the Nifty Bank, that's the one that's giving you that positive surprise. It's up 0.2%. Yesterday it broke the 20, 50 and 100 DMA. But lovely to see the Nifty Bank building on. Prashant, I think it sets us up for an interesting trading session with the first 3-4 minutes of trade.
Oh, no, absolutely. And, now to build on it, right? I mean, that's the thing. And so we were saying in the morning, right? Once again, we are approaching oversold conditions. Earnings are looking a little better, at least the ones which have come in today. But this is all very relative at the margin. So keep that in mind. But it's good to see some green absolutely on the screen. Mazgaon, I mean, just a few other names, right? It's all news related, mostly news related. Bajaj Finance is number one, volume-led gainer. And you've got Mazgaon Dock, which is up about 2%. So these shipping stocks all sold off aggressively yesterday. Paytm is up back above 700 rupees, so 4.5%. Lots of excitement around Paytm, lots of buzz around this one. News has finally come. Coforge is up about 5%. Amber sold off very sharply yesterday. It's bouncing 7%. Persistent, good set of numbers, outpacing revenue growth. All of the IT companies, 3.5% there. NMDC is up 4%. Max Financial is up 6%. SRF, Garden Reach, Hindustan Zinc, GMDC. These are all in the region of about between 2 and 3% at this point in time. On the downside, Zomato is the biggest volume-led loser. It's down a full 4.5%. And you look at something like a Chennai Petro. Chennai Petro is down 10, 11%, and it's got very large volumes in it as well. So 789, 788, 789 on Chennai Petro. When they move big, these standalone refiners, both the CPCL and the other one. M&M Finance is down about 5.5%, so no respite here. Gujarat Fluorochem, news related. Nimesh, of course, that D Street chatter getting confirmed. Stocks down 4%, but again, it's had a fantastic, huge rally recently. And I think Supreme Industries is down another 6% this morning after yesterday's 10% cut. They've lowered their guidance there as well. So that's essentially the things, the lay of the land. We got about a 30-odd point pop, which is 120 points from the opening low, almost immediately when the markets kind of bounce right back out. Let's actually cut across to the proceedings at the NSE, where my colleague from Money Control, Mahalakshmi, is speaking with some experts. Listen in.
In dollar terms. In rupee terms, obviously, it's gone up a lot more. Now, we are the 5th largest, nation in terms of market cap. We were 7th largest about 5 years ago. Cash turnover has gone up from 36,000 crores to about 1,22,000 crores. F&O turnover has gone up from 9,50,000 crores to about 400 lakh crores. Demat accounts have gone up from 3.59 crores to 17.5 crores. Demat account openings per month used to average around 3.5 lakhs. Now it is 40 lakhs. All of these numbers obviously tell us that from any dimension you see, and of course in terms of returns, we have had fantastic returns. Whichever way you see, whether it is turnover, the participation, the kind of volumes we see from outside of top 5 cities, the markets have grown. One easy thing to say is that investors chase returns, stock markets have done well, and therefore there is a lot of appetite. But in your perception, what are the key defining factors that you would attribute to this kind of stupendous rise that we have seen?
No, in a way, as you rightly said, 5 years, I would say 10 years, because that's what, in a way, there was a change in policies, change in a way of doing things in, say, 2014. But if you can take it as 2019 also, when Money Control Pro started. The way I look at it is, why do stock markets work? When you measure the markets from the flow, that is the trading volume that happens, I measure it in a way that how does a market help the society create wealth? The basic purpose of the market, although many of us, or most of us feel that purpose of market is trade and trade incessantly. That is not true. The purpose of the market is actually to do price signaling of assets. That is the philosophical purpose. How we achieve it is different, but what it does is that the assets get created, and today there are 2 ways in modern economy to create wealth in an economy. Channelize savings of an economy into productive capital. One is what we call intermediation, where you go through banks, put money into banks, and then banks on lend. But if the other side doesn't pay back, bank still pays you back, and that's the pretensions, that is the way we think it should happen. But the other side is called disintermediation, where you put money directly into a business. And there you need to have a trust of people who are putting that small little 1,000 rupees sitting in Srinagar, sitting in Jorhat, sitting in Dibrugarh, putting that 1,000 rupees in a company working out of Coimbatore. They are not never going to visit that company, but they have a complete trust in India's parliament, India's judiciary, India's ministries and regulators and stock exchanges, but more importantly, they have trust in India's entrepreneurs. That entrepreneur is going to work hard for your 1,000 rupees, her 1,000 rupees. And for me, that trust is what has got created. Usually, if you read the economics books on markets, it is very clear that countries with low per capita income cannot have good markets, thriving markets, because poor people don't save, and if they save, they don't trust even their brothers with their money. That's why they put money in gold and all. India is an outlier. With $3,000 per capita income, we have now the 4th largest, you said 5th, because you take Bloomberg data, and Bloomberg after 1998 should have merged Hong Kong into China, at least I did, and rest of the world, but Bloomberg still wants to project that Hong Kong is separate from China. But otherwise, India is 4th largest, and the market capitalization is $5.6 trillion, not $4.8 trillion. But besides that, there is no country in the world with $3,000 per capita income, which is our style of markets. $6,000, no market. $12,000, no market. $24,000, one market is there, whose name is China. When markets go down, government has to go and buy shares. You might have seen recently. In India, have you seen that in last 25 years? So that's why I'm saying this is a market of the people, by the people, for the people, but it is a trust between entrepreneurs and the investors. We all, including you guys, we or anyone else, we are just facilitating that. And that is what all of us need to understand, that it's very difficult to create that trust and very easy to give away that trust, right? So nothing should be done by any one of us who eat out of this, right? We are literally drinking out of the same pond, and anyone poisoning that pond, we'll all be hurt, right? So that is where I think this trust is so beautiful. I always say that over last 75 years, 77 years of independence, what India has achieved is trust in its entrepreneurs. And it's so beautiful that somewhere India has become a trustful nation, right? It's a very, very beautiful thing that has happened.
DP, I want to come to you because you crossed a milestone a few months back, 10 lakh crore, and you are perhaps present in every nook and corner of India, should I say? You're distributed everywhere. Tell us some anecdotes, numbers, things that demonstrate the trust that he's talking about. What is your hope? What do you see as an opportunity going forward? And what are the challenges?
No, I absolutely agree with what Mr. Ashish Chauhan has said. Reaching out to every nook and corner and selling trust rather than selling a product. When our people has the trust in the entrepreneurs of the country, and then channelizing that from the farthest part of the country and bringing it to the investment manager who is doing the complete research and investing every single penny of that person into those stocks. This is something which has happened in a very, very beautiful manner. Today we take pride that in all the especially the hidden everywhere you talk about Northeast, you talk about Kashmir, which he touched about. We are the market leaders because of the brand, because of the trust. People already had trust in the brand. People have channelized money through that channel into this. And today when we are having more than 1.5 crore SIPs customers into the market with the ticket size of less than 2,000 crores. Just to give you an example, the small cap fund, which is ours, and we don't take pride that we are giving the highest returns because we choose very, very good companies, has got 2.5 million investors every month coming with the ticket size of less than 2,000 crores. 25 lakh लोग जो हैं जो उसमें पैसा डाल रहे हैं हर महीने, और we are not accepting lump sum money, still we are getting 700 crores every month.
Well, that's $4 billion a month into equity mutual funds. That's essentially what Mr. Singh of SBI Mutual Fund, the country's largest mutual fund, is referring to. And of course, we'll cut back to the proceedings there. There is Samir Arora, as you could see from the visuals. There's Saurabh Mukherjee, and there are other market experts. We'll continue to dip in and out of that event. The big news, of course, is what you can see, that Money Control Pro has got 1 million paying subscribers. It's a historic milestone as far as the news business in this country is concerned. Well, the markets has had a swing, 120-point upswing. Then the market dropped into the red, and now it is up again 20 points, right? Look at that. That's what's happened. Opening low, is sort of up 100 and down 100, and now we're about 12 points in the green. What we'll do is we'll just go back to the proceedings at NSE and listen to Samir Arora in conversation.
And SBI and all, our assets were less than what we have in Helios now in less than 10 months. And I can see this thing of trust, you can call it, or because of the things set up by the mutual fund industry over the years to get that confidence and whatever protection, that we are in our 11-month history have got maybe investors from more than 300, 400 cities. For us, I can see broadly that, people investing 1,000 rupees after the first 5,000 rupees. We are now about 0.3% of their size.
Yeah.
So we hope that we have much more room to grow than the overall this thing. But it is visible everywhere.
So this time it is
but
for
this
real.
time,
this time the confidence that is built up in equities, the trust that we say. Every time in a bull market, one tends to believe this is real, but ultimately you're disappointed
on
because
that point, if I may say, on that point, I may say, because that is my favorite point, that don't look at last 5 years data of the market to say that this market has done very well. If you look at last 3 years, I'm talking about performance only. You look at last 3 years or 7 years or 9 years or 10 years or 15 years or 20 years, it's the same, which is 15-16% per annum. Last 5 years distorts it because it looks like 22% and all. You just make it last 7 years. for Nifty, for NSE 500. It's all the same. Therefore, I don't think it is out of line. But quickly on this alliance thing, in those days, there were less distributors. And so I would go and talk to 500 people, 1,000 people who were end investors.
Right.
So it was more fun, actually, than talking to a distributor who's acting tough with you.
Right, right. Rashesh, again, building on this point on trust, you know, the retail investors have definitely reposed a lot of trust in the market. One thing that sort of is a bit unnerving, I don't know, maybe that's too intense a word, but one disturbing trend is this promoters selling out, and that's been continuous over the last 3 years at least. Do you see that as a concern? You know, as a skeptic, I would say this is distribution. As an optimist, I would say this is democratization. As a realist, what would you say?
Okay, we'll keep dipping into that conversation and get you sound bites coming out of that event. For the time being, this market has been, starved of any kind of good numbers. And we've got one such number, Coforge. That's the management that's joining in on the show. The company reported a very good set of numbers, a well-rounded performance. Margins declined, but also that was because of a couple of one-off costs. They also witnessed solid organic growth with good order intake. We have Sudhir Singh, the CEO of Coforge, joins us on the show. Well, Sudhir, it's not just your investors, but I think the markets are cheering you today because we have been missing any kind of earnings beats. So very good performance is what you have delivered. But can you keep up this momentum? Give us a couple of numbers. Organically, can we see a double-digit growth for this year? And also, what should the margin band look like? The last quarter was, a couple of D&A and other inorganic related costs were there. But on a steady-state basis, what is the margin band?
Well, if you look at our numbers, the Coforge organic business itself on a sequential basis has grown 6.3% in US dollar terms. And of course, when you look at our aggregate numbers, the firm has grown almost 27% sequentially over the last quarter. So as we look ahead and we look at the next 12-month signed order book, which at this point in time is 40% higher year on year at $1.3 billion US dollars. As we look at the order intake during the current quarter, which was more than $500 million, it was exactly $516 million. As we look at the fact that our large deal pipeline, beyond just the 3 that we've announced in the last quarter, is looking even more robust, we feel very confident that not just the coming quarter, which is quarter 3, but quarters to come should see very robust and sustained growth. And we will continue to deliver that growth as we have over the last 7 years.
Sudhir, hi, morning. So if you could put some sort of, rough numbers to that, so that we can understand on a full year basis, let's talk, FY25, what will the base business, the organic business grow at, given the strong commentary, and also what the total sort of growth is going to be, given the Cigniti acquisition as well?
We don't offer a formal annual revenue guidance, but as you can see, just the quarterly growth this quarter has been 27%. Next quarter, we expect it, even though it's a seasonally weaker quarter for the IT industry, to be a robust growth quarter again, as should quarter 4 be. So on the whole, this should be, I suspect, a standout year for the firm. The growth should be robust, and it will continue to sustain.
Okay, I think the only niggling issue, not nitpicking, but I think it was something that was pointed out that for the organic business, the margin dipped a little bit in the second quarter. Can you elaborate on what the reasons are? And I think you've indicated to analysts that there could be some additional ESOP costs in the quarters ahead as well. So if you could throw some light on this.
Absolutely. Our margins at the end of the first half of the current fiscal, our EBITDA is 125 bips higher than last year first half. Quarter 2, the drop that you saw was largely because of the fact that global annual salary increments were done in this quarter. So the quarter in which you do it is the quarter that sees a downward blip. But overall, if you look at the first 6 months, we are 125 bips higher. And we believe that we have significant margin levers even going forward to make sure that we deliver or over-deliver on the margin guidance that we'd given for the year. We had said that our gross margin will go up by 50 bips this year over last year. Given where we stand right now, we believe we're going to meet that guidance and at a stretch exceed that guidance going forward.
But the EBIT level and the ESOP issue that I think was raised in the investor call, can you just tell us can you quantify the impact there?
Sure, the ESOP cost will be the same in BIPS level for the full year as it was last year. We've issued new ESOPs starting Q3. Q1 and Q2 therefore saw a depressed ESOP cost, but when you look at the full year, the cost of ESOPs this year is likely to be at the same level as the cost of ESOPs last year.
So, good morning, Prashant here. So, gross margin expansion can be, 75 basis points, 100 basis points?
It's definitely going to be 50 bips that we committed to, Prashant, at the beginning. Currently, where we stand, it's at the end of the first half, it's 60 bips higher than first half last year. If that trajectory sustains, we might land up at 60 or maybe higher. But 50 at a minimum, which is our guidance, is something that we believe is ironclad right now.
You've already given us the headline, a standout year for Coforge. And, it's almost as if, I'm not talking to an IT company, because most IT companies are, when we speak with, still largely the commentary has been slow and we're waiting for things to pick up, etc. But here you're talking about a standout year. So, I mean, we're wrapping up 24. We're looking at calendar 25. Interest rate cuts have started. Does that add to the confidence for calendar 25 as well? I mean, any early indications of budgets, etc.?
Prashant, it does add on the margins to the confidence, but our story, the Coforge growth story, has never really been driven by the demand environment ups and downs. Even last year, which was a very tough year for the industry, we had grown 13% in CC terms at a time when most firms were struggling to get to 3, 4, or 5%. So obviously, the demand environment easing with the interest rate movement that you alluded to will help. But even if it doesn't, we will deliver the numbers that we need to deliver.
Sudhir, throw some color on the Cigniti acquisition. Now that's closed out. How is that contributing? And you also mentioned there would be going to be cross-selling opportunities. So if you could quantify a couple of numbers on that front as well, and synergy benefits.
Absolutely. Cigniti in this quarter has grown sequentially 6.1%. So it's obviously exceptional growth that they've recorded. This was the first quarter in which we had operational control over that firm. Their margin, more interestingly, it's not just been a great revenue quarter for them. The EBITDA margin of Cigniti on a sequential basis has jumped 360 bips to 16.2%. When we announced the Cigniti acquisition, we had indicated that we would expect Cigniti to hit an EBITDA of 16.5% by the fourth quarter of this year. But we now believe that Cigniti is going to exceed 18% EBITDA by fourth quarter of this year. The cross-sell that you talked about is proceeding extremely well. The growth that we've seen in the current quarter of 6.1% sequential has not come because of the cross-sell opportunities that are in play. It's only been one quarter. We expect that impact to start coming in starting Q3 and to be fully reflected by Q4.
So that explains in part why you were saying this would be an exceptional year for Coforge. But just round it up for us. I mean, where is the confidence coming in from? I think the insurance vertical, as I can see the numbers here, has done really well for you. 8% sequential growth. BFS is growing. But, really, what makes you confident, and what are the sort of demand triggers that you're seeing out there and the clients that you're working with? I think you're executing contracts on the Gen AI side as well. So just some qualitative perspective as well.
Well, qualitatively, the thing that gives me the most confidence is the fact that every industry vertical of Coforge, every geographical unit of Coforge, and every technology unit of Coforge is doing well. To the point that you made, insurance has grown almost 9% sequentially. These are not YOY numbers. These are not annual numbers. These are sequential numbers. Insurance has grown almost 9%. Banking has grown more than 5%. The exact number is 5.2% sequentially. Travel has grown 6.2%. Emerging verticals have grown more than 7%. Now, when you have a firm which has all businesses, whether it's an industry cut, whether it's a geographical cut, whether it's a horizontal technology cut, all of them firing at the same time, you're not reliant on one vector which can go up or down because of an environment change. So a lot of the confidence comes, A, from the broad-based nature of the growth. Second, a lot of the confidence comes from the fact that our next 12-month signed order book is 40, not 14, 40% higher YOY. That number for a firm our size is $1.3 billion. And third, a lot of the confidence also comes from the revenue momentum. The last 7 quarters have been hellish for the IT industry. But if you look at us, 7 quarters back, we became a $1 billion revenue firm. 7 quarters later, of everything that's happened, at the end of this quarter, we're now running as a $1.5 billion firm. So a lot of that confidence, point number 3, comes from the execution that Team COFO just turned in and is likely to turn out in the future.
Sure.
All right. Listening to you, so a lot of investors would be calling up the brokers now. It's astounding and incredible as well. So it's an achievement and beautifully summarized as well. So thank you very much for joining us. Great to have you with us here, and appreciate your time on CNBC-TV18. So, that's as Sudhir described, tough 7 months, but COFO just sort of navigated it quite nice. I mean, very, very nicely, and $1.5 billion firm now. So 7289 is where COFO is. It's the biggest sort of earnings reaction which has come through. Well, we'll take a quick commercial break here. Devansh Jain of Inox Gujarat Fluorochemical Group will be joining us on their recent business updates. Remember, they've gotten investors in their battery chemicals business. So we talked to Devansh about that and more. Stay with us. Okay, welcome back. The market is volatile, and how, right? I mean, I think it's what, 9:45, so 30 minutes worth of trading, and I think we're in a third big swing of the day, up and down again. We're down about 54, 55 points as things stand right now. So that's markets for you. Well, Gujarat Fluorochemicals is the next company in question. They're in focus as the company subsidiary GFCL EV is raised 1,000 crores at an equity valuation of 25,000 crore rupees. Remember, Gujarat Fluoro's own market capitalization is about 50,000 crores. So this is a significant fundraise. Now, these funds have been raised from marquee investors, including family offices of some of the largest business groups in the country. Devansh Jain is Executive Director at Inox GFL Group, and he's joining us to take some questions. Devansh, good to have you with us here. Good morning. Prashant this side. Congratulations. It's a significant sort of development for investors in your company and for you as you look forward into this sort of, emerging big business line. Give us some details, though, Devansh. So this is a 100% subsidiary of the listed entity in which you've gotten these investors in. 1,000 crores worth has been put in, and the company is now valued at 25,000 crores. So if you can confirm those details, and who has put the money in, if you can give us some inkling, because I believe, Sunil Bharti Mittal's family office is one of the investors, and we got some of the other large family offices, corporate family offices also in. So give us a sense.
Good morning, Prashant. Pleasure to be back. This time, not for the wind business, for the chemicals business. It's a nice day. It feels good. It's a new business which we're building out very, very aggressively, very rapidly. GFCL EV is a 100% subsidiary of Gujarat Fluorochemicals, where we are setting up one of the largest integrated battery chemical complexes outside of China. We have raised 1,000 crores. While I will not name the family offices which have invested, what I could certainly give you is these are some of the largest business groups across auto, across FMCG, across cement, across metals. So very, very strong pedigree guys across family offices which have come in. We've diluted close to about 4% of GFCL EV to raise this capital. I don't know how much everyone knows, but to date, we've pumped in close to 1,500 crores of equity into GFCL EV. And we have a large capex plan of almost about 6,000 crores over the next 2 to 3 years. And this capital raise, along with potentially another round, should see us through that along with our internal accruals.
So 6,000 crores capex over the next 2 to 3 years is the plan here. Another round of funding Soon, a year out, by when?
Soon. We're talking to a few large private equity investors. We should be doing another round soon. And with that, I think we should be well covered. The aim is to raise about 2,000 crores, 1,000 odd we've raised from family offices. Potentially another 1,000 would be raised. And that, along with the 1,500 which we've already put in as equity, would be good enough to see through the entire business plan without any debt. I mean, as you would be aware, the Inox GFL group is very debt averse. We don't like debt in any of our businesses. With this raise, along with the incremental raise, basically all the capexes will be funded from the equity and internal accruals. There will be no borrowings whatsoever across the group.
The business, though, just to kind of you're going to be making batteries, right?
No, so
putting
what
together.
we make is basically three parts, right? We cater to the entire EVV and the ESS ecosystem. So it's battery chemicals, which is basically electrolytes, salts like lithium hexafluorophosphate, and various formulations and additives which go into the battery, along with cathode active material, which is LFP, and high-end fluoropolymers, which are used as binders, which is both PVDF and PTFE. In effect, broadly, the products which we make, depending on the chemistry, constitute about 40% of the battery. And the battery constitutes about 40% of the electric vehicle's cost. So in effect, we control about 12 to 15% of an electric vehicle's supply chain.
And this would be 6,000 crores, 2 to 3 years, building out what capacity? I mean, if you can give us a sense. I mean, so for example, when we speak with OEMs like Ola, they give us they're building out this gigafactory, right? I mean, they want to be integrated, and they're building out a large capacity over the next few years. So give us a sense of what, and they would be your customers. Who would be the customers here for you? I mean,
I think just to give you a little overview about the EV landscape, we expect the market to move from about 1,100 gigawatt hours to about 5,000 to 6,000 gigawatt hours by 2030, opening up a $300 billion opportunity. I think what's happening is, with the Inflation Reduction Act in the US, primarily supply chain, 90-95% of the battery supply chain was out of China. And with the IRA, you've effectively cut off the entire Chinese supply chain. So effectively, the entire US market is ideally looking for a key supplier. And I think we fit right in. We are early movers. We've got a majority of the plants up and running. We've gone through multiple rounds of approvals. We are currently in sampling and final trials of our products across our commercial plants. And we expect to start commercial supplies from Q4 FY25. Having said that, I think what's also important is, outside of China, there are only 1 or 2 small players in Korea and Japan, which gives us a very, very large opportunity to build out this business. While I won't specify exact numbers, but I mean, in LFP, for example, we're looking at over 1 lakh of tonnage. In LiPF6, we're looking at almost 30,000 tonnage over the next 3 years.
Devansh, just to come in over there. So that's the thing that investors, sometimes grapple with, to try and understand specifically what would be the opportunity for an Indian company. And from what you're saying, it looks like obviously you're catering to the international market and domestic. So if you could give us a mix, how much of it will be international, how much domestic? And isn't there some concern about, while of course it's a big theme and it's here to stay, but isn't there some concern about a little bit of a slowdown in demand as well?
No,
in the near term, that is.
Look, effectively, as I mentioned to you, the global opportunity is expected to play out from about $65-70 billion currently to almost $300 billion over the next 4 to 5 years. Currently, the supply chain is primarily China-driven. And with the Inflation Reduction Act, for example, in the US, it's banned. You can't be with the Chinese. Effective 25 and 26 for various products. That's where we step in. Europe,
no, but how much of this would you want to target, Devansh? That's the global picture we've got.
Let me just explain this to you. In Europe, what's happening is majority of the OEMs are moving away from the Chinese supply chain. So you don't have IRA, but they need to have an alternate. And I think that's where we fit in. Now, if you look at the size of the market, almost 55% of the market would be the ex-China market. So currently, maybe the total market, the TAM where we would be playing is about 40 billion, moving up to about $150 billion. At peak, we would target about 7% of the global market. So while you look at a slowdown, which is primarily India, India is very, very small in our larger scheme. And India is really going to play out from 26. Majority of the battery plants are getting in shape now. You'll have some capacities coming up next year, be it Ola and so on and so forth. It's too small. We're really playing the global markets at this point in time.
Okay, hi Devansh. Congratulations on this, big announcement, and you clearly seem very confident and optimistic about the future. Give us a few quick numbers, though. Out of the 1,000 crores, how much is the promoter entity putting in?
So the promoters have put in 200 crores. The remaining is coming 200, and the remaining is coming from the larger family offices across India.
Got it. That's out of the way. Next up, what is the ROE you're expecting on this business? Currently, I think it's around 17-18% for GFCL.
Look, we would expect much higher than that, but I would not be able to. Talk about that at this point in time.
Point number 3, will you be looking at listing this business? That should be the eventual plan, say in the next 3-4 years?
Yes, certainly. I think as is known across Inox GFL Group, we build out businesses, capitalize them well, and once they're on their own, we eventually list them. So certainly for GFCL EV as well, we would be listing this over the time period you mentioned.
Okay, in the next 3 to 4 years. And this remaining 1,000 crores that you were talking about, a fundraise, will be done at similar valuations, and should we expect it in this fiscal year?
I would expect so.
Okay. Devan, just one thing. You said this business is already up and running for you?
So all our plants, so we've got our LiPF6 plant running, we have our electrolytes plant running. In this quarter, we expect to commission our LFP plant. So these are all commercial plants. I mean, it's a very, very rigorous approval process. You'd have a pilot plant, then you have a commercial plant. It takes a year from the pilot plant, then from the commercial plant, another 9 months odd. So we've got sampling done, validation going on. As I mentioned, Q4 is when we expect to start commercial sales of most of these products.
So FY27, right? What would roughly? I mean, just to give a sense of what we're looking at, what could revenues be?
In excess of $1.5 billion.
From the EV business.
That's right.
Okay, FY27, $1.5 billion in revenues.
On an investment of 6,000 crores.
Well, the investment will play out. So that would be for the larger top line.
Okay.
The turnover ratio we would look at about 2 times, but
2 times,
2 to 2.5 times. But effectively, 6,000 would enable us to supply,
12 to 15,000 crores.
And growing at what rate, Devansh? From there on, you mentioned those numbers. $150 billion TAM. You like a 7% share. So sure, I mean that's a very large.
But that's in 2030. Let's get there. I think at this point in time, the TAM is at about 40 billion. We are ramping up. I think, as I said, with the equity raise we're doing at this point in time and the equity we've already pumped in, the internal accruals are large enough to keep growing that business. So, I mean, we're looking at abnormal growth rates for the next 3 to 4 years. And then they would peter down, but I think they would be fairly high even at that point in time.
Got it. All right, Devansh, thanks a lot for joining. Congratulations on this big announcement. We look forward to touching base with you as you raise some more capital and as things progress. Well, time to move on then. It's time for our special segment, Quarter Se Quarter Tak, where we get you earnings expectations from every sector. Vamakshi joins us to tell us how Q2 will shape up for the capital goods sector. Vamakshi.
Well, Q1 was a solid quarter for most industrial product companies with strong commentary on tender and order pipeline. Looking ahead to Q2, domestic order inflow is expected to ramp up now with the election and the budget behind us. Private capex is likely to see selective growth in sectors like data centers and industrial automation. Exports may still continue to be a bit of a mixed story. Exports for companies like Cummins are likely to bottom out, while for sectors such as energy transition, turbines, as well as transmission and distribution, they are likely to be robust. We expect strong double-digit revenue growth. Margins may sustain given the demand dynamics, healthy pricing, and benign commodity prices. However, in some cases, they could moderate a bit sequentially from abnormally high levels that we saw in the first quarter. ABB is expected to post a healthy quarter driven by strong execution in its electrification and motion segments. Revenue is projected to grow by 18.4%. Margins may expand by 262 basis points and net profit is likely to rise by 35.4%. Siemens revenue is expected to grow by 11.9% on a high base with healthy growth in its smart infrastructure, mobility and energy segments. EBITDA margin for the company could come in at 14% with broad-based expansion across segments, and net profit could see an uptick of 27%. For Cummins, this is the first quarter post the transition to the new CBCP4 Plus gensets. Macquarie's channel checks suggest relatively better absorption of increased prices. We're expecting exports to recover sequentially and forecasting a nearly 17% growth in its revenue, 22.9% growth in its net profit, and 161 basis points jump in its margins. Thermax is likely to see a growth of 12.4% in its revenue, led by better execution in industrials and products and green solutions, and a rise of 10.6% in its net profit. Margins may expand slightly by 15 basis points, but Macquarie believes that with the receipt of two large international orders and a low base, order inflows may rise sharply by almost 75% on a year-on-year basis. For BHEL, we expect 17% growth in its revenues. This will largely be driven by power and industrial segments, while we are expecting negative EBITDA margin of 0.64%. It is still expected to be an improvement of around 700 basis points on a year-on-year basis. Net losses too could narrow to 103 crores. Order intake is expected to be very strong. And lastly, let's talk valuations. Of late, valuations have marginally cooled down from recent highs seen in the first quarter. Interestingly, I also looked at how valuations stacked up in 2015-2016, which is when the BSE Capital Goods Index had peaked earlier. Most companies, with the exception of Thermax and Cummins, are trading below the highest PE seen in the 2015 to 2016 period.
All right, Vamakshi, thank you very much for that. That's really helpful. And yes, in a market that's been correcting, quite aggressively now, a lot of these stocks like ABB and Siemens, they've given up only, between 10 to 15% from the peak, not more than that. So can the earnings match up? Priyankar Biswas, India analyst, industrials, logistics and metals at BNP Paribas is with us now. Priyankar, good to have you on. And that's the real question, right? The market has very tall expectations from these stocks. They've been bid up aggressively, still trading at those multiples of 80 times northwards. What are your key expectations?
Yeah, thanks for having me. So I will just put it in a very slightly different context. So these stocks industrial stocks that we are speaking of traditionally had a 60 to 70 times multiple. But usually what has happened was that the order inflows deliveries has been quite strong. And consequently, the numbers that came up in terms of revenues, margin expansions were far higher than what consensus was building in. So what we see, let's say, as a 60, 70 times multiple in the given context, if the number delivery is much stronger, then it would probably be actually lower. So we see that particularly in the T&D space and the power side of things, the order inflows may continue to be very strong. I mean, even going forward into the next year as well. And so the strength may continue to be retained in this particular space, particularly things more aligned to the T&D side of things.
Okay, all right. Hi, Priyankar, and good to see you. When Priyankar, our audience is wondering at these valuations what to buy though. So tell us, what is the best, who's best place, keeping in mind the kind of valuations that is trading? If you could give us two of your top picks.
So of course, in the core infra space, I would pick on L&T at this point. So the reason is, if you would see that the stock price is somewhere around 3,500, 3,600 levels. And there has been a concern of late that maybe the order inflow guidance may miss. That is what the general concern is. Especially like in 2Q of last year, you had some mega orders coming in from Saudi Aramco and one high-speed rail order. So these are lacking here. But given that this is not an election year, domestic order inflows should come up in the next half. And contrary to expectations, the Saudi tendering has actually been quite robust. It's just that L&T's win rate has come off. So on the core, I will see that the margin, that the core multiples have dropped off significantly for L&T. And that is why we would actually suggest that these stocks actually makes quite a sense. And compared to the capital goods, our stance has been that we should focus more on the hard infra logistics sector side of things. So more something like a JSW Infra or an ATACZ. So that would be our focus areas as well.
That's a really interesting point you raise. Why is that, Priyankar, that you're not looking at the core industrial automation / power equipment companies like ABB and Siemens, and you're looking at hard infra players? Why is that?
So the key reason is, so when I gave you the positive thesis on the T&D themes playing out, so of course this would benefit someone like let's say a CG Power, or let's say a Siemens, or even a Hitachi. But the point is the valuations, if you see, already kind of captures a lot of the positives. We cannot say exactly the same thing about the logistics space, because the point is, in a growing economy, the logistics space also grows in tandem, maybe sometimes even higher. So a good example would be like if you have, let's say, strong steel consumption demand happening in India, which is even happening today as we speak. So there is this headwind of China spreads and those. So in a sense, the consumption of raw materials that is related to the steel aligned sector, that will still go up. So we would rather play in the real economy side of things. That is why we are proposing that we look at logistics.
Got it. Having said that, just to go back to pure industrials, again, the ABB, Siemens, Cummins and Thermax variety, given the elevated valuations that you flagged off, what is the run rate in terms of earnings growth, top line growth that these companies will have to deliver in order to prevent a big disappointment and a big fall? And out of this lot, which one do you like the most? Where do you think the earnings compounding story can continue the best?
Yes, sure. So as I was mentioning, that the T&D remains our thrust area. So in a case like we have a significant transformer shortage as we speak today, and there would be a very significant amount of high voltage linked ordering in the substation space. So clearly at this point, the names which are there in that space, like a CG Power or a Siemens, and even let's say on the EPC side, a KEC would be benefited. But having said that, the valuations have also run up to a great degree. Where we feel that the valuations are not justified, let's say in sort of a Cummins India, like for example, we had taken out a report previously on that the discount that it had to something like a Siemens or ABB had shrunk down massively. Given the headwinds, that should not be the case. So it's a relative call, maybe I will have to say. However, if the plays deliver, let's say, a 20% plus EBITDA CAGR for the next 3 years, then yes, the valuation still remains justified.
Okay, all right, Priyankar, appreciate you joining in, giving us your quick analysis of the sector and how you see things shape up. L&T, the top pick in the infra space for Priyankar, who's over the last few years got quite a few of these calls spot on. Well, quick check on the markets. It's good to see we are approaching the end of the first hour of trade, and the Nifty has recovered from the day's low. The Nifty Bank is performing as well, and you have a lot of stocks that are moving around. By the way, Biocon, I think there was some negative news flow that was flashing for you on the screen. There appears as a big short covering bounce that's taken place. Now the stock has moved to the high point of the day, so sharp uptick is what we're seeing on that counter as well. Good move. And from the Nifty pack, let's just pull out a few stocks out there. Maruti Suzuki, that was breaking some crucial levels on the downside. I think that's popped up. It was trading in the red. It's moved into the green. Always helps the cause. Coal India as well, another one that's been seeing some selling. That as well has been doing quite well. Well, time to slip into a short break. Up next, Lata will be in conversation with Mr. Nitesh Ranjan, the Executive Director of Union Bank. Stay with us.
Welcome back to Corporate Radar. The stock on the radar at the moment is Union Bank. Union Bank reported subdued loan growth but steady margins. The rise in return on assets and return on equity was encouraging, but slippages were worryingly high. Joining me now to decode the results is Mr. Nitesh Ranjan, the Executive Director of Union Bank. Mr. Ranjan, good morning and thank you very much indeed for joining us. Well, let me start with the worrying part first. The slippage is rising from about 1% to about 2.4%. What accounted for the rise?
Yeah, good morning and thank you for having me here. If you recall, in the first quarter con call, we had said that we have a couple of accounts where we are likely to see the stress in the second quarter or the third quarter. Out of that, one account has actually materialized and it has turned NPA during the current quarter. That is why the delinquency ratio which you are seeing is higher. If you remove that one-off account, then delinquency is actually well below 1%.
Okay, I am assuming it is MTNL, but anyway, I guess you cannot mention names. But can we say this is a one-off? Will your slippage ratio start falling from Q3 and Q4?
Yeah, so let me give the perspective. Last quarter, we had said that we are seeing stress in 2 accounts, out of which one has now materialized. One still is on the radar. Okay, now if we look at the annual guidance for the slippages for the bank, we have told 11,500 crores for the full year.
Yeah.
As of now, 7,500 crores is the slippage in the first half. Now, if you remove this one-off in Q2, actually the slippage in the bank is around 1,800 crore only. So if I take that run rate, then we are still hopeful that we'll be able to maintain the guided level of 11,500 crores of slippages for the year.
Will you far undershoot it? That would be the hope. Will you?
That would be difficult if the other account which I spoke about, that also realizes and turns into NPA.
Okay, okay. What about the recoveries? You all have done 7,300 crore so far, compared to a guidance of 16,000. Will you meet that target?
Yeah, recovery for the last 2 years, we have been surpassing our own guidance. And this year also, we are very hopeful to do that. In the half year already, 7,300 crore of recovery is there. And there is a good pool of accounts which we are targeting through various methods. And I'm sure that we'll be able to cross that 16,000 crore of guidance.
Okay. The other encouraging part is the fall in NPA ratios. You have guided for 4% at the end of the year. Will you get there? You are now at 4.36, right?
Yes, we are in that direction. And that is something very, very sure that we'll be able to meet the guidance of 4% gross NPA.
Okay, that's good to hear. But the overall credit cost has risen. Will it stay at 1.1 levels, or can it get even more troubling?
So actually, if you look at our guidance we gave in the beginning of the year also, this year's credit cost should be below 1%.
Okay.
And this increase in the credit cost for the quarter is because of the one-off account which has slipped. Barring that, actually, the credit cost on normalized basis is below 1%, which you should be able to maintain.
Okay. Well, you know, when you in the place where you have given up the breakup of your difficult loans, there is a slippage in LC and others. Is that something we should worry about in the slippages?
No, so that one large account, LC is the large corporate division. Yes.
Okay, that is included under LC, is it?
Yes.
Okay. Did you have any trouble with unsecured loans and MFIs? What is the performance?
So our total unsecured loan portfolio is around 12,000 crore, which is around 1.5% of the total loan book and around 7% of the total retail loan book. If you look at the growth, it is almost flat YOY in the unsecured loan, and the delinquency ratio is quite manageable at around 1.45%. Entire unsecured loan gross NPL also, if you look at today, it's below 2% level. So far as MFI is concerned, our exposure is very limited. Hardly, I think, 20% of the loan book is to the MFI, and few marquee names only, not many players. And we don't see any stress in our loan book to MFI as of now.
Okay. Let me come to growth. It is a bit troubling that your advances are lower, quarter on quarter, 1.6% lower. How do you see the second half growth in loans?
Yeah, I think the quarterly and YTD growth, we should split into RAM and the non-RAM sectors. RAM sector still QOQ also, there is a 5% growth rate aided by the retail, agriculture and MSME. There is a flat growth in the corporate, and as we have been telling that our focus in the bottom line, we don't want to grow just for the top line and sacrifice the bottom line. So there is some kind of sacrifice in the large corporate book we have done, where the pricing was very, very kind of challenging for us, and we have sacrificed that. Otherwise, it's okay. 11 to 13% is the guidance for the annual growth rate in advances. And I think the RAM sector should support that. In the festive season, we are seeing very good demand in retail. MSME, since middle of the August, we are seeing good pickup in the sanction and disbursement. And we should be able to reach to our guidance level for advances.
Okay. What would your guidance be for loan growth?
That is 11 to 13%. Okay. We should be anywhere in between the guidance range.
Okay. Okay, that's good to hear. I think your LCR ratio is very healthy, 144%, if I'm not mistaken. Would you maintain it at this level? Would you run it down? And what impact can it have on margins if you brought down your LCR?
I think LCR is a comfortable level. We should also factor in the RBI's draft guideline on the increased runoff factor that will take anywhere between 10 to 12% from the current level of LCR that we are reporting. So which will be around 125 to 130% if I factor in that runoff thing.
Mr. Ranjan, just a few more questions. If the you expect the LCR rules perhaps to come in the second half. Do you also expect the higher provisioning on project finance to come? And if that comes in the second half, what may be the impact?
See, I think I have on your channel told earlier also in the guidelines, draft guidelines came that this is a very prudent and forward-looking approach that RBI has proposed. I'm not sure when those guidelines are going to be finalized and in what shape, because different stakeholders, including banks, have given our suggestions. So depending on that, we'll take. But I think if I remember the number, the impact is not very significant.
Okay, all right. Well, let's get back to the markets because as I said earlier, we're doing quite well. The heartening aspect actually is not the Nifty. You pull up the mid-cap index. That got an absolute pounding yesterday. That's pulled back and that's at least up close to around 500 points as we speak. 1% gain on the mid-cap index. Mitesh is back with us. Mitesh, what do you make of this bounce? A good shorting opportunity, you would say?
Not right now, Nigel. I think given the fact that we have slipped a lot, I think the bounce back could still play out on the upside and you might see higher levels. And the level which I would watch is the first area is around 24,600 of this spot and then 24,800. So I think 24,600 if it manages to cross to sustain above this level, then I think you might see the pullback play out all the way till about 24,800 odd levels. Give and take a few points, and then from there, if there's weakness, we will want to go into the short side of the positions aggressively.
Okay, all right, and I think we're very close to this 100 DMA right now. So my director will pull that up, the Nifty with the 100 DMA. We almost crossed that mark, so that's another important technical level. Mitesh, want to give us a couple of stock calls?
Angel, Wipro and IT is doing well today. Wipro is something which I would recommend buying with a stop at 542 for targets of 570. In fact, it's not fallen much in the last few days of decline, and some of the IT names are still making fresh highs. So I think that's where the strength is. So Wipro is something which I would recommend buying for targets of 570, as I said. And the other call which I have is slightly on the negative side. So we'll keep a balance there. Grasim is something which I would want to short with a stop at about 2681 for targets of 2600.
Okay, all right. Thanks a lot, Mitesh, for giving us a call on the index as well as individual trading picks as well. Before we get into that break, let's just pull up the Nifty. We have moved above the 100 DMA, so that's encouraging to see. The Nifty up close to around 80 points, and now that's the mark that I'm talking about. Hopefully, it gets closer to around the 20 DMA. I think for the time being, we'll slip into that short break, come back. We should focus to the commodity space. Stay with us.
Welcome back. Well, let's now shift focus to the commodity markets. Manisha is here with the details and the action as always. Manisha, what's capturing your imagination today?
Well, it's a season of all-time highs, really, when you look at precious metals. So gold is doing that, but silver is doing even better. So with 3% of gains in the overnight markets, we've seen $35 an ounce come in for this one. Slight profit-taking, as is always the case. When you see that huge run-up come in, there will be some hands which will go in for some profit-taking there. But even with these gains, the kind of levels that we are working with right now, the gold prices are trading at a 12-year highs in the international markets, and the Indian prices have seen 1 lakh rupees in the New York session yesterday, which is an all-time high for the prices. So even as we are looking at 99,700 odd in the futures market, in the spot market, you will add GST to this, you will add making charges to it. So it's basically is a lakh rupee plus when it comes to the physical markets there. When you look at the prices on how they've done in the recent past, well, we have seen prices gain up by 9% in last week. 46% now in this year and 51% in the matter of last 12 months. So that is what silver has done for you in your portfolio there. Well, the reason that silver prices are surging is one, there is strong investment demand that you have seen come in for this one. And then apart from that, the record high gold prices, safe haven demand that silver also caters to in some sense have been supportive. There is also a record offtake that we've seen come in from the photovoltaic as an industry. And then it also has been about the mine output, which has continued to be stagnant, supporting prices. I want to talk about the world global deficit, and that is a market which continues to support the prices. So this is going to be a fourth straight year that the global silver markets are into a deficit. Last year was almost at around 184 million ounces of a deficit. This year is even higher at 215 million ounces. So we continue to look at those kind of numbers there. The street also is looking at the industrial demand, which is hitting record highs. This is also going to be a fourth straight year that the industrial demand for silver is going to hit a record highs. The markets do believe that going forward from here, it is going to be further highs that you can see in case of silver. A Citi report that came in yesterday suggests that next 6 to 12 months, you could be looking at silver prices hitting $40 an ounce. There also are reports from UBS, JPM, Goldman Sachs, everybody saying that it is going to be anywhere between $38 to $42 on the higher side that you could see for silver prices in the next year.
Okay, all right. Thanks a lot for that, Manisha. Well, we have Dodla Dairy's numbers that are flashing for you on the screen. 30% growth on the top line. Good performance, it looks like, on the top line. Let's get the profitability number as well. That should come up for you on the screen. The EBITDA number as well is up close to around 36%. So, good one on that stock. But let's go across to Nimesh. He's here to tell us about Bajaj Auto. Nimesh?
Hi, Nigel. We heard the management yesterday and they was quite confident. Rajiv Bajaj was quite confident about Q2 and Q3. But Goldman Sachs has today gone ahead and upgraded the stock to buy from neutral, and they've raised the target price to 12,500. Now, Goldman's upgrade is based on few theses. One, they expect a 17% domestic two-wheeler volume growth visibility in FY25, which is the current year. 55% large addressable market in the three-wheeler business, where they are market leaders. Third, pick up in the export volumes. Fourth, more runway from the current current levels for the two-wheeler cycle. And 5, a good positioning in the 125cc market. So that's the key reason why they believe that Bajaj should do well. On back of all this, Goldman has raised the FY25 and FY26 EPS estimates by up to 40%. So a big earnings upside is what Goldman believes. And hence, after a 20% correction, what we saw recently, an upgrade to a buy now on Bajaj Auto, and target price now raised to 12,500.
All right, big one out there. Thanks a lot, Nimesh, for joining in and giving us that top brokerage call that you're tracking. Well, keep an eye out on a few stocks in the broader markets. We have IOB that's moved to the high point of the day. So good move is what we're seeing out there. HFCL as well has now moved higher. It's up close to around 4%. So these are some of the top volume movers. While on the flip side, we have IDFC First Bank that's seeing some selling. So that stock is down close to around 3% as we speak, currently at the low point of the day. Well, I'll tell you what, it's time to wrap up on this edition of Bazaar Morning Call. But you stay with us, because Chartbusters comes up next.